Good morning and welcome to this Wednesday, March 2nd, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, we got an interesting day ahead, as if all these days aren't interesting. Everything's interesting, it seems. But today might be particularly interesting. I mean, we got the ADP jobs report out. Russia driving deeper into Ukraine. Oil prices absolutely soaring. They're up another $7.60 a barrel this morning to 111 now per barrel. Just crazy. 10-year Treasury yield's been all over the place the last few days. Today, up 7 basis points, back to 1.78%. Got the Fed kind of in the middle of all this, not really knowing what in the heck to do, to be honest. I'm not sure I'd know what to do if I was there as well. Just a lot going on, a lot to consider, and literally they're going to be walking a tightrope here in the very near term as this war rages on over in Ukraine. And with inflation, look at the oil prices. I mean, now granted, when you look at the stripped out version of inflation, when we look at the core level, we take out food and energy. So all these spikes in oil won't be a part of that. But I mean, the headline number that we're going to see here over the next month or two is going to really spook a lot of people. And the number, even if you strip out food and energy, is still going to spook a lot of people. So market, kind of gyrating all over the place. We've seen that in terms of the crazy movements back and forth. We've seen it with the volatility index continuing to be, really high. Normally we see the VIX, maybe 10 to 15 range. That's where it normally hangs out during bull markets. Yesterday we closed at 33. And I can just tell you that during panicked moves, 33 is high. And we've actually rallied. We're sitting at 33 after we've had a pretty decent rally. Now, yesterday we were down, 600 on the Dow and a couple hundred on the NASDAQ. But we're closer to the recent highs than we are to the recent lows, or at least somewhere in the middle. So I don't know, just 33 VIX seems really high to me right now, considering that we're not even in a panicked sell-off right now. So anyway, the market is just going to be crazy here, I think. During the month of March. And to know whether we're going higher short term or lower short term, I mean, if you're here listening to me, hoping I'm going to give you some direction, I hate to disappoint you, but you'd probably be better off flipping a coin, because I honestly don't know. I still think the market goes lower, but the craziness and the wild swings back and forth, this is unpredictable behavior in the market. Again, I think the overall trend remains to the downside in the near term. The overall trend long-term remains to the upside. And what we've got here for the next 30 days is anybody's guess. I believe we go lower, but some of that's going to depend on the Treasury yield too, because many of these growth stocks, I believe, is what's going to lead the market lower. And as the Treasury yields fall, that gives a little bit more bullishness to those growth stocks. When rates are lower, valuations are generally higher on growth stocks. So anyway, got a lot going on, and I'm going to be talking about a lot of the confusion taking place in the market right now and some of the things that the Fed is looking at as we go throughout the show. All right, let me go ahead and pull up the screen for you. Let's get this thing going. For those of you who are new, welcome. Love to have you. For those who regularly join us here on Trading Places Live, thanks for the support. If you go over to Earnings Beats, if you are new, go to earningsbeats.com and just scroll down. We have a free newsletter. Name, email address, hit the subscribe button, completely free, no credit card. You can unsubscribe at any time. Comes out 3 times a week. I featured an industry group this morning that I think is worth keeping an eye on, that actually has been fairly bullish during the 2022 campaign so far. And it's pulled back recently, so it gives us an opportunity potentially for entry if you're looking for something. There aren't too many places I would go on the long side right now, but there are areas. I mean, obviously energy has been doing extremely well. And defense, which I talked about recently, defense has been doing very, very well. Lockheed Martin is absolutely on fire right now. And that was the chart that I provided on Monday morning. in the earnings beats digest. So if you got that, looked at it, decided to get in, you've been pretty happy so far this week. I think Lockheed Martin was down closer to 400. Now it's 457. That's just in 2 or 3 days. So it's been a huge move. Anyhow, make sure you sign up for this if you're not already a subscriber. We'd love to have you. And we're not going to, all your information will remain private with us. We don't sell lists. So you don't have to worry about, your email address getting out anywhere. We're not releasing it to anyone. All right, let's take a look at what happened on Tuesday. We definitely rolled back over. You can see the Dow Jones Industrial Average down 600, the S&P 500 down 68, NASDAQ down 219. But you can see, the Dow might be a little closer to the low than is the recent high. S&P is more in the middle, but look at the NASDAQ. NASDAQ sitting probably in the middle, maybe even slightly above the middle between its low. Actually, it's probably sitting right about in the middle. Low was near 12.5, high was near 14.5, and now we're sitting at 13.5. So literally sitting right in the middle. And that VIX is up 33. Again, normally that's when you're putting in the panicked low when you're up into the 30s. We're already at 33. That's really one thing that bothers me a lot about this market, and what tells me we could go big in either direction. And I've been, very bearish in the near term, but when you've got a VIX at 33, the sentiment is already wound tight. Like everyone is nervous and on edge. And that usually results in big moves in the market. So my guess is it's to the downside, but I wouldn't be shocked if it's back to the upside. Market tends to do what we don't expect it to do. So anyway, we'll see what happens. Watch the 20-day EMA. I'm going to talk about that a little bit more later in the show with some key stocks as well. But you can see all the major indices rolling over beneath the 20-day, which is beneath the 50. In this kind of a, with this kind of a look on the chart, I'd have to give the edge to the bears. We're downtrending. That's the definition of a downtrend. When your price action's below the 20, which is below the 50, you're in a downtrend. Call it whatever you want, but it's a downtrend. Mid caps down 52, small caps down 25. You can see that same configuration. One positive that I've mentioned recently, look at the AD lines on the Dow and the S&P 500 breaking to new highs. Now it's starting to roll over again with yesterday's action, but this is pretty good to be sitting near a high like this. Even the NASDAQ's not far from its high. That's one signal that tells me this isn't going to last to the downside, and eventually I think we turn back up. But if you go in on the long side, you might have a month or even maybe a few months to have to deal with more downside action before we actually roll back to the upside. And of course, there's always the possibility I'm just totally wrong, and maybe this thing sells off for 3 years. I don't believe that's the case, but market can do anything. All we can do is use technical analysis to help us manage risk in the way that's appropriate for us. Moving on to the sectors, energy breaking out. Shouldn't be any shocker there. My gosh, oil prices going absolutely through the roof. But energy prices broke out above that 71 level, closed there yesterday. Another big breakout there. Financials down almost 4%. I can tell you treasury yields. When you look at the 10-year treasury yield and the huge movement to the downside the last couple of days, we were up near 2%, and all of a sudden 1.7. 30 basis points in about 2 days. That's crazy. So of course, financials getting hit pretty hard. Testing a key area of support though. We'll see if financials should bounce today, especially with the yields up a little bit. Materials rolling over underneath their 20-day. Technology, same thing. Discretionary. These last two are really important to watch. Market's going nowhere if these two stay below their 20-day moving average, in my opinion. This is a big part of the S&P 500. So if technology and discretionary can't turn up, chances are the market's not turning up. Just like when technology and discretionary weren't turning down, there were a lot of areas of the market not doing well, but technology and discretionary stayed pretty strong right through year end. Technology setting new highs at the end of December, consumer discretionary right there, right beneath their highs. It's hard for the market to go down when those two areas are holding it up, but you can see 2022 has been a different story. So we've got to watch these two areas to make sure that if you're on the short side, you want to make sure they stay below the 20-day moving average. If you're on the long side, you're hoping beyond hope that they get back up above that 20-day and begin to, look a little bit better technically. 10-year treasury yield. Well, first, we had the ADP report out this morning, and just to kind of throw a little kerosene on the fire, the February ADP employment report was just a little bit higher than expected. The estimate was 320,000 jobs, came in at 475,000. So normally you're going to see yields react to the upside. Anytime the economy is showing more strength than expected, normally the reaction is to sell bonds. You don't want to be in bonds with a fixed rate of income when the economy is strengthening, because profits grow, you're better off in stocks usually. So that's the normal move when you see a hot employment report. But I don't know if you noticed, and I didn't see it in the headlines. I actually had to go back and see what the prior month had, what the revision was. But if you remember, the ADP employment report in January had come out with a minus number. Remember, it was minus 300,000. They've revised it to positive 509,000. How do you miss by 800,000 jobs? I don't even understand how that happens. I haven't done any research this morning trying to figure out whether there's an explanation for what was going on there. But I believe, and I'm going off of memory, but I believe the ADP employment report came in really weak with that minus 300,000 number. And then non-farm payrolls 2 days later came out with a much bigger number, positive. And now the ADP employment report is adjusting their prior number by 800,000. It's like, did you just miss half the population? What? I don't even know how that happens. I don't know how you have an estimate that gets revised that much, but or a prior number, I should say, that gets revised that much. But anyway, that's what the number showed, unless what I was looking at was an error. But I'll be looking at that a little bit more later today, just for my own well-being, trying to figure out what's going on with jobs. I don't understand why such a major revision. Anyhow, that's basically the only thing coming out today in terms of economic news. This is the second day of the calendar month. I've talked a lot about money flows. We typically, the stock market, really the three best consecutive days, without a doubt, in the stock market. And I'm talking about since 1950. The three best consecutive days of the calendar month end today, the 31st, the 1st, and the 2nd. And there is no other 3-day period that's even close. So any maybe historical tailwinds that the market's getting right now will begin to subside. The rest of the week, actually through about the 5th or the 6th, tends to be pretty good. But the level of bullishness drops off after you get past the 2nd of the month. So historically, market does pretty good today, but we got to at least be thinking that if that's helping the market right now, it's not going to be there for the market here over the next few days, or certainly into next week. All right, so the 10-year treasury yield, let me make sure we got the latest update, because this has been all over the place as well. 1.78% right now, up 7 basis points. That should help financials today. So look for financials and some of the value stocks that have been getting hit a little bit harder of late. I would expect to see them maybe outperform, and maybe some of the growth stocks underperform today with rates moving back up. But the question is, do the rates stay here? I mean, are we going to go back up to 192% or 192%? Or are we going to stay down here, at 170? This was the double top breakout at about 170. Now we have triple bottom right at about 170. I tell you, move back below 170 here, and the bond market is going to be saying, hey, forget about inflation. We got a recession on our hands. That's kind of the message it sends to me. But the Fed, I mean, you've still got Powell coming out saying, expect the rate hikes. The rate hikes are still coming. I mean, that's been the latest. He's talking now that, yeah, there's some uncertainty with what's going on with, Russia and Ukraine and all the sanctions and what that's going to mean. But it's uncertain. We don't know. We're just going to continue to monitor it. But we know what's going on with inflation, so we feel like we need to raise rates. That's kind of what's coming out from the Fed right now. There's so much going on, whether or not the Fed is right or wrong. I personally think that they're in the process of screwing things up, which wouldn't be the first time that this particular Fed has screwed things up. Fourth quarter 2018 was the last time, calling for rate hikes, 2 of them in 2019. They ended up cutting rates in July of 2019. They got it wrong. And in the meantime, while they were getting, and you think, well, okay, so they got new information, they just, corrected their mistake. Well, the problem was their mistake cost people lots of money in the stock market. If you remember when they were talking about those rate hikes, the stock market was getting killed in the fourth quarter. We had a bear market, cyclical bear market back then. And I think a lot of it was fueled by the Fed. All of a sudden, once they came around and decided, oh, we need to cut rates, stock market was fine. So I think I think things are a little bit crazier right now, to be honest. I think it's harder. And I do think that there's a little bit more of a tightrope that they're going to have to walk through here over the next few months, depending on how long this conflict lasts over in Ukraine. But I think they're going to screw it up. That's just my own opinion. And I think the bond market thinks they're going to screw it up. We're going to talk about that in just a minute. But the 10-year treasury yield here, you can see, watch that 170 level. I think a move back. If we go back down, break below 170, to me, that is not a good sign. That's a lot of money pouring into bonds at a time when inflation is supposedly high. Why would you be pouring into bonds at 1.7% when inflation, which I'm going to show you in a minute, the core inflation is over 6%? Who wants to own a 1.7% yielding bond when inflation's at 6%? Makes no sense. Anyway, down here at the bottom, what I did is I put in the growth stocks. Normally, I show you the financials, how they perform relative to the S&P and then the industrials. Today, I just put on here the growth stocks and the growth stocks relative to the value stocks. Large cap growth versus large cap value, by the way. These are all large cap. And this is what was holding the market up, by the way. Large cap growth up until the end of December, even though it was starting to show relative weakness versus value stocks, it was still actually moving higher on an absolute basis. That's what kept the S&P 500 afloat. Once the growth stocks started getting hit, and I wrote an article about Apple back at the end of December, how if Apple started to sell, it was going to take the market down with it. Well, Apple has actually been a pretty decent performer. It's gone down, but on a relative basis, it's been pretty good. And yet its drop has been part of this large cap growth drop, which has killed the S&P 500. Let's face it, that was the only thing left holding the market up. And now you can see this downtrend. And right now, the low we saw back on, I don't know, maybe about a week ago on this growth index at 5,000, this was a level we hadn't seen since back in June of 2021. And I personally don't think it's over. I guess we're going to find out pretty soon, because I think if we're going lower, we're probably going to go lower in March. But as the yields have been dropping here over the last 2 weeks, normally we would expect that to be a good thing for growth stocks. Growth stocks have continued moving lower, even with rates coming down. And on a relative basis, they continue to underperform value stocks. So what does that tell you? I mean, if yields are coming down and growth stocks still can't catch a bid to the upside, at least not one that lasts, and it continues to underperform its value counterparts, I don't know. To me, it's just painting a really bearish picture. I mean, what happens to the growth stocks if the yield goes back up? Fed says they're still going to raise. I mean, if inflation really is a problem, let's move on. I got some more talk about inflation in a minute. I want to get into that because I think it's pretty important. So here's the S&P 500. Here was your head and shoulder breakdown, which honestly wasn't as big of a event as I thought it was going to be, because volume didn't really support it. There wasn't huge volume on this breakdown. You would think going back to about a 7-month low, taking out 2 prior support levels, we would see huge volume on that breakdown. And in fact, volume went down from its previous couple of days. I mean, it's still, when you look out over time, it's still pretty heavy volume, but I would expect a breakdown of a head and shoulders to be like the highest volume over here on this chart. It wasn't. Actually, the bigger volume was on the day when we recovered back. So the volume, everything's kind of mixed up right now. But we are still trending below the 20, which is below the 50. But if you want to mix things up a little bit more, look at that positive divergence. We've got lower prices, higher PPO. So that's why potentially I could see all of a sudden the market taking off and going back and getting a 50-day test, because sometimes we see that with positive divergences. 50-day test, get that PPO back up to the center line, and then maybe the big swoosh comes in. It's really hard in a VIX environment of 33 to know exactly which way this market's going to go. And whichever way it goes, it's probably going to go a lot. And it's probably not going to last long. It's probably going to whipsaw you. So it's a market environment that honestly, I don't like to trade. I would much rather be in cash or playing the direction of the trend, maybe using ETFs that track the indices rather than individual stocks. Problem is you get in individual stocks and you're wrong. Some of these individual stocks can get hit, 30, 40% in a very short period of time. Yeah, they can go up 30%, but let's don't forget about the risk you're taking if you're wrong. They can go down that 30% as well. And that's the part I don't like. I try to manage my risk a little bit better than that. So anyway, it looks to me like we're trying to roll over, but watch that 20-day. If we get through the 20, we do have a positive divergence that could lead to a 50-day test. And I hate to be sounding like, oh, well, it could go higher, it could go lower. Honestly, that's the kind of market you get into with a VIX at 33. Again, I think the overall trend is down. I expect we're going lower, but I wouldn't be shocked if we got the breakout back to the upside. I believe it would just be temporary. I don't think we've seen a low. I still kind of would say maybe 70-30 is what I would put on whether we go to a new low on the S&P. I would say it's 70% chance we do. And I think we're going to go down to 38, maybe even 3,500. But I think some of this depends on how this conflict in Ukraine resolves, what the Fed decides to do. I mean, if the Fed remains adamant on raising rates, then I think we're going down to 35, 3,800. I just don't see any way out. But that's just my opinion. All right, let's talk a little bit about inflation. Here's the crude oil prices. So, of course, everybody is talking about crude oil right now, and why not, right? I mean, my gosh, just take one trip to the gas pump, fill up your tank, and you'll know why everybody's talking about it. Crude oil yesterday up $7.69 to 103 per barrel. And let me give you the latest right now, where it is right now. 110. It's up another $6.48 to $110 a barrel. I mean, these are levels we haven't seen in many, many years. That big drop we had in 2014, all of a sudden back up again. Now down here on the bottom, I have a 22-day rate of change. 22 trading days is roughly 1 month. And if you look at the move over the last 22 trading days in crude oil, we're up 19.4% rate of change, 19.4%. And historically, when we look back, 25% in a month usually caps things. I mean, it's almost right to a T, 25% across here, but there've been a few spikes. 2009, obviously, when we went up to $147 a barrel, you can see that spike on the rate of change was pretty strong. Or even after that, after we pulled all the way back, and then we had the big spikes from the lower levels. That's when this was high. The spike to 147, by the way, we didn't get up to it, but to about maybe 15, 20% on the rate of change. So it was just a really steady kind of move to the upside. 2015 and 2016, after big drops in energy, we saw these rallies back and we got big numbers on the rate of change. Well, crude oil prices, of course, in the pandemic went down quite a bit. And right here, as you can see. And then we bounced back. And I mean, that was just crazy. The rate of change, basically we were going from zero. So of course the rate of change is going to be almost, it's going to be a ridiculous level. But look at where we are relative to history. I mean, we're getting up close to that 25%. Throw in today's move. And it certainly looks to me like, we could maybe be at 25% or above that by this time tomorrow. So I don't know. I think crude oil obviously is going to remain a problem. And when crude oil gets too high, too fast, it does have the ability to really help choke off the economy. And if the economy already is beginning to weaken, and we've already got consumer sentiment dropping, this huge rise in crude oil and having a war and so forth, this is not going to help. And so all of this stuff could trigger a recession, which I started talking about a while ago. I said that was going to be the next thing. And I believe that's going to be the next thing. I don't even know that it matters what the Fed does. I think at this point, we're getting closer and closer to what I believe is going to be a recession. We'll see about that. Let's talk a little bit more about inflation, though. So here is the core CPI over the last 50 years. This is just the reading that comes out each month. So right now, Last reading, I think, was 286.43. That was the January 1st number. We'll get the February number out. I don't know, probably in the next week or so. I haven't looked to see when the date is. But anyway, so that's just the actual reading of the consumer price index, which is a basket of goods. Now, the rate of change in the consumer price index is shown in the second panel. This is the 12-month rate of change. It's a monthly chart, by the way. So when you pick 12 periods, it'll be a 12-month. So this is just showing us a history of the core CPI on an annual basis. And you can see back in the 70s and into the early 80s, the huge move. The other thing down here on the bottom, I put the 10-year Treasury yield. So I want you to look at what the 10-year Treasury yield did in the 70s and into the early 80s. As inflation was soaring, look at the yields soaring. Now, the reason that this happens is that when inflation goes up, investors are going to want higher rates of return. And the other thing is when rates go up, or when inflation goes up, the Fed raises short-term rates to try to battle inflation. So that impacts a bank's bottom line. The only way that banks can earn what they want to earn is to raise prices, quote unquote, raise prices themselves. Well, they don't sell products. Well, they sell products, but they don't sell things like consumables. They sell loans. And so when they raise prices, they're raising prices on loans. That's how, and the 10-year Treasury yield is probably one of the key, lending rates out there that kind of goes with the mortgage rates. So when 10-year Treasury yield moves up, that's generally a sign mortgage rates are moving up, or vice versa. So anyway, you can see what the 10-year Treasury yield was doing when the yield was, or when the 12-month rate of change on inflation was soaring. The yield's going up, and that's generally what you're going to see. Even this spike in 83, 84, we saw a spike also in the 10-year Treasury yield, maybe a little aftershock. But notice what happened in 90, 91. We actually had a move. We had a cyclical bear market in the stock market when we had this move up to 6% in inflation. But look at the 10-year Treasury yield. Suspiciously, it didn't go up. Never even went up above the recent highs of the last couple of years, even though it looked like, at that point, we had moved to about a 9-year high in inflation. Wouldn't folks sell bonds? Well, not if you don't believe the inflation is going to last, right? And so the yields kept going down, and guess what? So did inflation. And also, guess what happened? The stock market took off to the upside. This was just a false, the stock market, I always say the bond market's smarter than the stock market. The bond market, I like to watch the reactions in the bond market. I think that gives us more truth than reactions in the stock market. Like right now, the stock market's been going down mostly for the last couple of months. That might give you the sense that things are really horrible. That's the way we tend to think. If the stock market's going down, things are horrible. If the stock market's going up, things aren't so bad. Although some people, even when the market's going up, still think things are horrible. Always want to be on the negative side. But anyway, I just draw this 90-91 parallel because if you look at what's going on right now, look at the huge spike in the 12-month rate of change of core inflation from just over 1% to over 6% in the course of 1 year. Huge spike. This is looking like the 1970s. Why is the yield still in this downtrend? Yeah, we're coming up, but we're coming up off of historical lows. We're coming up off of zero. The yield's not really spiking. And even the last couple of days when we've seen it drop 30 basis points in a couple of days, why would folks be going into bonds if inflation is such a big problem? That would be the first thing I would sell. If I worried about inflation, I am not holding on to fixed income investments. Just not doing it. Every day I'm in and inflation goes up, I'm losing money. So what normally happens is that when the Fed is raising rates, the Fed funds rate, that is impacting banks in the short term on the expense side of the interest ledger, because they're now having to borrow at higher costs. They also, because their depositors can now go out and get other short-term instruments for higher price, the banks have to start thinking about paying their depositors more in interest. So a lot of stuff's being paid out. On the other side of the thing, they're originating mortgages. And the problem is that investors on the long end don't want to continue to buy these mortgages, these packaged mortgages at a low interest rate if they're worried about inflation. So it's almost like it drives the yields higher. And I'm really oversimplifying to some extent what I'm trying to say. But bottom line is when banks are being impacted by rising Fed funds rates, which is what the Fed's telling us we're going to get, banks then are almost have to raise rates, or you get that inverted yield curve. And if you get the inverted yield curve, it almost always leads to recession. I mean, once banks start to lose money, or not lose money, but just get squeezed, I can tell you they're a very conservative bunch. Having audited banks, they're a conservative bunch. And so as a result, they tend to be very picky about who they lend to. And so access to capital is very difficult. So that's what really starts to contract the economy. So the way to deal with it is to raise rates on the other end. So net interest margin at banks remains high. Well, what we're seeing so far is that the long end of the bond yield, or long end of the yield curve, not really budging much to the upside, not like the short term, not like what the Fed is talking about. And that is the problem. And that's where I think we're going to be looking possibly at a recession down the road. Anyway, let's strip out consumer, or strip out the food and energy, and you get core CPI. But if you include food and energy, you get the headline number. This is just CPI. Now, one thing I want you to notice, now we're just over 9:30. I'll try and wrap this up quickly. One thing I want you to notice is just how much more the ups and downs are. Go back over here and look at this, and it just looks smoother. And that's why the Fed looks at this number, because food and energy prices literally can go up and down all over. I mean, look at what's going on right now with crude oil based on the conflict. I think most folks would agree that if Russia ends the conflict, or if they come to some kind of an agreement, crude oil prices are going to come back down almost immediately. These are short-term moves to the upside and downside. And that's what the Fed tries to eliminate. If inflation is a structural problem, it's not going to be a structural problem because Russia decides to invade Ukraine. It's a structural problem if it goes beyond food and energy. Food, you can have weather conditions. All of a sudden, something shoots up because of bad weather or lack of rain. You get a drought in certain parts of the country. Again, these are things that fluctuate wildly. So when you're looking at the headline number, just expect that the moves up and down are going to be much more significant, which is why a lot of times that's why it gets quoted in headlines, media, because it's more startling. The core number, however, is going to be smoother, and you're not going to see as much. But look at what's going on even with the core number, huge move. The headline number now is getting close to 8%. It's going over 8, probably over 9. And with crude oil, we could see double digit. I wouldn't be surprised to see double digit given what's going on with crude oil prices. And that as a headline number could really spook some folks. So just kind of keep all of this in mind. I just wanted to point out the fact the bond market isn't buying into a lot of this right now. The stock market is. Stock market sees all these headlines. Oh, we're selling. And then you got, firms like Goldman Sachs going out there saying they're going to be 7 rate hikes. Where are they at the end when there's only 1 or 2 rate hikes? I mean, I've never seen them apologize or, keep in mind, Goldman Sachs has a market making unit. They benefit a lot of times by prices going down so that they can get cheaper prices in their market making unit for their institutional clients. So biggest conflict in the stock market, without a doubt, hands down, are these big financial firms that have one part of their firm going out and telling Wall Street, oh, wow, 7 rate hikes ahead. This is going to be awful. And then they have the other part of their business buying those cheaper shares. And that's why we see the AD lines, accumulation distribution lines, going up. I mean, some of this is crazy. Anyhow, 10-year Treasury yield now is up to about 1.8%. It's up 8.5 basis points. Crude oil 110.50 right now, and futures are up. And we got Dow futures right now up 170, S&P 20, NASDAQ 55. This is a 10-minute delay. But let's go ahead and take a quick look and see what the market's doing now that we're open. See exactly where we are. NASDAQ 34, Dow up 190, S&P 21. If we pull up the NASDAQ, and I'm going to end with 3 charts. Actually, I'm going to end with 5 large cap stocks that I really think we all need to watch closely here, because I think where they go is where the stock market's going. So, and you can probably know which 5 stocks I'm talking about without even me showing you. But let's take a look. First, obviously, Apple. Actually, we'll start with NVIDIA. Let's come over here, start with NVIDIA. So NVIDIA, let me give an update, see where we are today. So we're up a little bit, up a buck. See how we're trending below the 20. We did go up briefly above the 20, but only to test the breakdown. And then as soon as we got to that point, we went back down. Now we're below the 20, which is below the 50. But notice we're not that far from a 52-week high in accumulation distribution. So even though prices have been going down, I could argue there's plenty of buyers still willing, as everybody panics and gets out of these prices, there's still buyers out there. And it's another sign why, in my opinion, we're not going to have a long-term bear market. It's going to be a cyclical, short-term thing. And once it's over, then we go higher. Maybe we consolidate for a while over the summer and then go higher later in the year. But I think we're going to bottom probably in the next 30 to 60 days. That's my guess. All right, so that's NVIDIA. Let's do Google. Same thing. Google actually down 11 bucks, but see the 20, see the failure at the 20. How about Microsoft? Microsoft failing at the 20. Tesla went above the 20 yesterday, couldn't hold it, up 5 bucks today so far. We'll see if we can get through. It's been struggling at the 20. Look at that AD line. We went from 1200 down to 700. That panic when everybody sold out at 700. Look at that hollow candle. Look at the volume. Who do you think's buying? Everybody else is panicking. Retail traders were panicking. Now, once they saw it moving back, maybe they were jumping on board. But when it gapped down at the open, I can promise you it was market makers buying. And Apple. Of course, Apple. Apple up 4 cents right now. I mean, it went up, tested its 20-day from underneath. It just looks like everything wants to go lower. Look at the AD line on Apple, right near 52-week high. I believe that Wall Street is going to use this as another 2020, another pandemic kind of a thing where they're going to jump all over these stocks that are getting beaten up. The baby out with the bathwater. Guess what? Wall Street's catching the baby. They're holding on to the baby because the baby's going to bounce back. And that's the way I see it. So anyway, sorry to take so long today. We went over. I really wanted to get into that inflation talk and the way the bond market's reacted. I think that's important as we look at what's going on in the market. So we'll see what happens today. I don't know which way the market's going. I'll be honest. It's so hard to call. I suspect we're going to fail at the 20-day moving average. That would be my guess. My educated guess is that we roll back over, especially once we get past the first couple of days of the month and that new money flow slows down. I think that's going to make it more difficult for the market to really move higher. And then, of course, we'll see what news we get out of Ukraine. Anyhow, that's it for me. Everybody have a great day. Tomorrow, you'll be able to catch me over at Stock Charts TV for your next episode of Trading Places Live. That begins at 9 a.m. Eastern. So simply go over to Stock Charts, click on that Stock Charts TV that I'm pointing at right there. Click on that, and you can listen to the show at 9 a.m. tomorrow. Everybody have a great day. Happy trading.